Welcome back. Chapter 4 is on accrual accounting concepts, which is another extremely important chapter. I think chapters 3 and 4 really are the two foundation chapters for all of accounting. So please, again, make sure that you keep up with me. So in chapter 4, we're going to look at four basic topics. We're going to look at the timing issues, that is, when you recognize transactions. Remember in chapter 3 we talked about accounting transactions. We'll talk in this chapter about when we recognize them, and then what we're going to call adjusting entries. How do the adjusting entries work? Basically, they're entries we make at the end of the period to make sure the financial statements are correct. And then remember in chapter 3 we dealt with a trial balance. We're going to look at another trial balance called the adjusted trial balance. And then we're going to prepare the financial statements again. Remember that we did that way back in chapters 1 and 2, but we're going to revisit that here. And then finally, something we call closing the books. This is what we do at the end of every accounting period to get ready for the next accounting period. Let's first talk about timing issues. And if you recall, back in chapter 3 we talked about a concept called the periodicity assumption, which is the accountants divide the life of a company into artificial time periods, which could be a month, it could be a quarter, 3 months, or it could be a year. Every company does at least a year. What is the periodicity assumption? Well, if you remember, that is the assumption we make that the life of a business can be divided into artificial time periods. The next timing issue we have is called the revenue recognition principle. This has to do with when we recognize revenues. And it says companies recognize revenue in the accounting period in which the performance obligation is satisfied. We have an obligation, for example, if we sell a product, we have an obligation to deliver that product. If we provide a service, we have an obligation to deliver that service. So until the obligation is satisfied, we cannot recognize revenue, even if the customer already pays for it. They may pay for it now, or they may even pay for it later. We recognize revenue when the obligation is satisfied. For example, assume Conrad Dry Cleaners cleans clothing on June 30th, but the customers do not claim and pay for their clothes until the first week of July. Now, if we waited till we got the cash, we'd be recording the revenue in July. However, we've already, it says they clean the clothing on June 30th. That is, remember, what's our obligation is to clean the clothes. So that's why in June, you'll see that we recognize the revenue. And we use an account called accounts receivable, meaning it will collect later on. In July, we're just showing that we collected the cash, but notice there's no service revenue down in July. The service revenue is back here in June. As a corollary to the revenue recognition principle, we have the expense recognition principle, which says we match expenses with revenues in the period when the company makes efforts to generate those revenues. In other words, you record revenues. What kind of effort did you have to make? Well, you had to pay your employees, you had to pay the rent, you had all of those utilities and such that you had to pay. So you recognize the expense in the same period they help to create those revenues. And there's an old saying, let the expenses follow the revenues. So the timing issues can be summarized in this slide in that we have the periodicity assumption. It says the economic life can be divided in artificial time periods. And then we have the revenue and expense recognition principles that tells us when we recognize those revenues. And of course, they would go into those artificial time periods. And then we put those two things together, and that is what we call a GAAP. In other words, generally accepted accounting principle records revenues and expenses according to those principles and assumptions. So we're going to see later on, that's in contrast to what's called the cash basis. This is GAAP, which uses the accrual basis. We'll see that in just a second. And this is just an interesting insight here. It says that allegations of abuse of the revenue recognition principles have become all too common in recent years. And in fact, if you look at fraud examples, they're almost always related to revenue recognition, because revenue recognition is a timing issue. So here's the example for Krispy Kreme. It says they sometimes double the number of donuts shipped to wholesale customers at the end of the quarter to boost quarterly results. In other words, they would be able to recognize the revenue because they actually deliver the product. But then the customers ship the unsold donuts back after the beginning of the next quarter for a refund. So that is that's fraud. I mean, that you're only shipping just to get them back to bump up your sales for the period. That's not allowed. And then we have another company, Computer Associates International, accused of backdating sales. It's sort of the opposite, saying that a sale occurred at the beginning of the one quarter. Saying that a sale that actually occurred at the beginning of one quarter occurred at the end of the previous one. So you're putting the sales last quarter, even though they happened this quarter, in order to achieve your results. What motivates sales executives and finance and accounting executives to participate in activities that result in inaccurate reporting of revenues? That is, this type of fraud. Well, mainly what motivates them is greed, right? They may have a bonus or something like that if their profits are higher in one period, so they're willing to do this thing. But unfortunately, sometimes they end up going to jail for these types of things, so don't do it. So I mentioned earlier the difference between accrual accounting and cash basis accounting. Accrual accounting is GAAP. We have, under generally accepted accounting principles, we're supposed to use accrual accounting or accrual basis accounting. So under that basis, transactions recorded in the period in which the events occur. And revenue, under the revenue recognition principle, are recognized when the services are performed. Even if we didn't get the cash yet, we're still going to record the revenues when we perform the service. And expenses are recognized when they're incurred, even if we didn't pay the cash yet. So when you get the cash or pay the cash is not relevant to accrual accounting. It's when you provide the service or incur the expense. Very important concept in accounting. Cash basis is different. Cash basis revenues are recognized only when you get the cash, and expenses are recognized only when you pay the cash. So that is not allowed under generally accepted accounting principles, or GAAP. Not allowed. So accrual accounting is GAAP. Just as I show you the difference between the two. Suppose that Fresh Colors paints a large building in 2013. In 2013, it incurs and pays total expenses, salaries and paint of $50,000, and it bills the customers $80,000, but does not receive the payment until the next year in 2014. Under the accrual basis, the revenue is recognized when you have satisfied the performance obligation. When was that? In 2013, when you completed the project. But under cash basis, revenue is recognized when you get the cash. Notice it's in the next period. And then expenses are matched to those revenues, so we record that in the same period they're incurred. And under cash basis, it's when they were paid, which is also in 2013. So look at the difference in net income. In 2013, we had an income of $30,000 compared to a loss of $50,000 on the cash basis. However, the next year we show no net income for accrual and $80,000 for cash basis. They're the same across 2 years, $30,000 plus 0 is 30,000, and minus 50 plus 80 is 30,000. But it's the timing that's important, because your investors and creditors and bankers and such, they're all looking at an individual year to see what kind of profits you made that year. So we have to use accrual accounting under GAAP. Which one of these statements about the accrual basis accounting is false? Be careful with these questions. You have to look for the ones that are false. A, companies record events that change their financial statements in the period in the event in which the events occur, even if cash was not exchanged. So that's a true statement. Remember, we're talking about accrual accounting here. B, companies recognize revenue in the period in which the performance obligation is satisfied. That's a true statement. That's a revenue recognition. This basis, that is accrual basis of accounting, is in accordance with GAAP, and that is a true statement, so that's not it. Hopefully it's D, it's our last one. Companies record revenue only when they receive cash and record expense only when they pay out cash. Well, that's the cash basis, so that's not accrual accounting, and that's what we were looking for. Well, let's now talk about adjusting entries. See, the problem when you're using accrual accounting is that these revenues and expenses have to be recorded and matched in the appropriate period. So in order to do that, we need adjusting entries to ensure that the revenue recognition and expense recognition are followed, to get those revenues and expenses in the proper period. And they're required every time they prepare the financial statements, if it's monthly, quarterly, or annually. And adjusting entries include one income statement account and one balance sheet account. Every entry does that. And they never include cash, because we're not adjusting cash, we're adjusting everything related to revenues and expenses. So the review question, adjusting entries are made to ensure that, well, those three things that we just looked at in the previous slide, they're all listed here, so therefore it's all of the above. Really important to get these ideas down. I think of the 4 chapters that you've covered so far, this is probably where a lot of students have trouble making these adjusting entries, because it's not related to a bill that you get or a sale that you make. It's come to the end of the period and you need to update the accounts to make sure they're in accordance with the revenue recognition and expense recognition principles. So we have 2 basic types of adjusting entries. We have deferrals and we have accruals. The gist of deferrals is that you are deferring the recognition of a revenue or expense. And accruals is you're recognizing revenue and expense in advance of when they're actually recognized. So, and then within each category there are 2 types. So under deferrals we have prepaid expenses and unearned revenues. Prepaid expenses are expense paid in cash and recorded as assets before they are used or consumed. In other words, you have an expense that you pay for now, but it's not actually an expense until later on. So you're deferring the recognition of that expense to a period when you actually incur the expense. Unearned revenues, cash received before the service is performed. All right, so it's the same kind of idea. The customer pays you in advance of when you actually deliver the product or provide the service. So you're deferring the recognition of the revenue until you actually perform the service. And accrual is just opposite. So we have accrued revenues and accrued expenses. Accrued revenues are revenues for services performed but not yet received in cash. In other words, you perform the service before you got the cash. So you have to accrue or recognize the revenue now. And accrued expenses, they're expenses incurred but not yet paid in cash. So what has happened is that you incur an expense this period, but you don't actually pay for it until the next period. So you have to accrue or record the expense in advance of paying for it. Well, you might remember the trial balance from chapter 3. It's just a listing of accounts, all of the accounts with their related balances in debit and credit format. And so with adjusting entries, we have to go through every account. Besides cash, we have to look at every account and say, are any of these accounts need to be adjusted or updated? So let's take a look at some examples. How about prepaid expenses? Remember, that's a payment of cash that's recorded as an asset because the service or benefit will be received in the future. So you've got your cash now, you paid your cash now, but you haven't actually incurred the expense. And there are several examples: insurance, supplies, advertising, rent, equipment, and buildings typically have prepayments. So again, they are prepayments. Prepaid expenses are costs that expire with the passage of time or through use. The adjusting entry results in an increase, a debit, to an expense account, and a decrease, which is a credit, to an asset account. So for every time you make an entry for prepaid, you're going to debit an expense and you're going to credit some asset account. So again, here's an example. We debit an expense and we credit some asset account. For example, Sierra Corporation purchased supplies costing $2,500 on October 5th. Sierra recorded the purchase by increasing the asset account supplies. This account shows a balance of $2,500 in the October 31st trial balance. An inventory count at the close of business shows that there's 1,000 of supplies are still on hand. So what has happened is that we bought the supplies and we paid for them in advance of actually using them. Now we're talking about supplies, could be any kind of supplies. They could be computer ink, it could be computer paper, it might be grease and oil for your machines. Whatever those supplies are, you paid for them in advance of actually using them. So they're going to be an expense, but only when they're used. So in the meantime, we'll call them the asset supplies, and notice that when you purchase them, down here you put in the supplies account, which is your right here I changed colors, supplies 2,500. However, you get to the end of the period and there are only 1,000 left, which means what? You must have used 1,500. So we need to make an adjustment. Supplies expense 1,500, which is the beginning 2,500 minus the 1,000 left. And we need to reduce our supplies account. And so you can see the supplies account, here's the adjustment to supplies. Oops. That's the supplies expense. Sorry, this is the adjustment to supplies over here, and the adjustment to supplies expense here. Okay, so let me get rid of this. Try that again. We have our supplies expense, and we have our supplies adjustment. Here's a different example. October 4th, Sierra Corporation paid $600 for a one-year fire insurance policy. Coverage began on October 1st. They recorded the payment by increasing prepaid insurance. This account showed a balance of $600 on the October 31st trial balance. Insurance of $50 expires each month. So we're going to take the $600 because we want to get it into the monthly basis here. We're going to do this every month. So we divide it by 12, and so that insurance has really cost us $50 a month, but we paid all of it in advance. So when you bought the insurance, it's not expense yet because it hasn't been used. So we put it into an insurance account, and you see that prepaid insurance, which is an asset. And then as you use it every month, we're going to debit insurance expense and credit the prepaid insurance. Okay, this is increasing the insurance expense and decreasing the prepaid insurance. Another example of a prepaid expense is build property, plant, and equipment like buildings and such, and we call this depreciation. The gist of it is this: when, let's say that you bought a car that you use in your business. Well, the car is going to be used in business, so it's eventually going to be an expense, but that's only when it's used up over time. So when you buy it, you're going to put it into an asset account and then report a portion of the cost as an expense, which we call depreciation, during each period that you use it. So that's why they call this a deferral. You're deferring recognition of the expense until when you actually use the car in your operations. Now, some people look at this word depreciation and they think that means a decline in value. It's not a decline in value. It's merely what we're saying right here, allocating or writing off a portion of the cost during each period of its life. For example, assume that depreciation on office equipment is $480 a year or $40 per month. So we've got some equipment here on the books already. We bought that before, and we're going to write off $480 a year. Of course, divided by 12 is $40 a month. So what we're going to do is we're going to record depreciation expense, which is the write-off of that equipment or the allocation of that equipment. We're going to use an account called accumulated depreciation. So the expense goes into as a debit, and then we have accumulated depreciation here, which is we'll see in a second what that means, but this accumulated depreciation is related to this equipment. So accumulated depreciation is considered a contra asset, which just means an opposite balance of normal. Remember, assets have a debit normal balance, so contra asset would have a credit balance. So it appears just after the account on the balance sheet and offsets it. So you'll see that equipment less accumulated depreciation, and then we have sometimes called the net equipment here. So this is a contra asset. It is subtracted or offset against the equipment. So to summarize the accounting for prepaid expenses, you'll see the examples here. We have insurance, supplies, advertising, rent, depreciation. Those are some things that we sometimes pay for in advance of actually using them. So what we have is prepaid expenses. We have to put them in an asset account until we've actually used them. And so what happens is assets are therefore overstated and expenses understated because we start to use those assets and they become expenses. So we need an adjusting entry to debit the expense and credit whatever the asset is. Well, let's change now to unearned revenues, which is, again, we mentioned this before, it's a receipt of cash recorded as a liability before services are performed. In other words, we get the cash before we record the revenue. Why? Because we haven't performed the service yet. Remember, we recognize revenues under accrual accounting when you perform the service. So a customer pays you in advance and you perform the service later, you cannot recognize the revenue until you perform the service. And some examples include rent. You have to pay your rent before you actually use the apartment. Airline tickets, magazine subscriptions, customer deposits. Those are things normally you pay for in advance of actually using the service. So what we have to do is record that unearned revenue as a liability, but then when you actually earn the revenue, you have to debit the liability and credit the revenue. Here's an example. Sierra Corporation received $1,200 on October 2nd from Knox for guide services for multi-day trips expected to be completed by December 31st. Unearned service revenue shows a balance of $1,200 in the October 31st trial balance. They paid you up front. From an evaluation of service Sierra performed for Knox during October, the company determines that it's earned $400 in October. In other words, they paid you in advance, and by the time you got to the end of October, you have not performed all the services yet. You've only recorded part of the services. So what do we need to do? Reduce the liability because the service that we owe them, we've already given them now, and we increase our revenue. So we reduce the liability and we record the revenue. So as a summary, we have unearned revenues, and their examples here: rent, magazine subscriptions, customer deposits for future service. The reason for adjustment: unearned revenues are recorded as a liability when you receive the cash, but once you provide the service, they're now recognized as revenues. So before the adjustment, our liabilities are overstated, our revenues are understated, so we need an entry to correct that or adjust for that. So we reduce our liabilities with a debit and increase our revenues with a credit. So we just talked about prepaid expenses and unearned revenue. Both of those are called deferrals. Now we want to talk about accruals, which are the other type of adjusting entries that we need. For example, accrued revenues. Revenues for services performed but not yet received in cash. So this is the opposite of an unearned revenue. Remember, unearned revenue, the customer paid us in advance. With accrued revenues, the customer we provide the service, but we haven't gotten the cash yet. So what we have is the revenue recorded before we get the cash. And this happens sometimes with rent, interest, and services performed. So the adjusting entry serves two purposes: to show the receivable that exists because the customer owes us, and to record the revenue because we've already provided the service. So what do we have to do in our adjusting entry? We have to debit the asset, which typically is accounts receivable or some kind of receivable, and credit the revenue because we have performed the service. An example: in October, Sierra Corporation performed guide services for $200 that were not billed to clients before October 31st. So they did not receive the cash yet, but what do? We earned those services. So I have to record the receivable. That's an asset. Customers owe us. And we provided the service, so I get to record the revenue. Notice we're accruing revenue, that is, recording revenue before we get the cash. Why? Because we've already performed the services, right? Already performed the services. So a summary: we have accounting for accrued revenues of like interest and rent and services performed. And why do we need the adjustment? Because services were performed but not yet received in cash. So we need to record the adjustment. because before the adjustment, our assets, which would be the receivables, would be understated, and our revenues, which would be the services, are understated. So we need an adjusting entry to debit the asset, and normally accounts receivable, and credit the revenue account, normally service revenue. And the opposite of a prepaid expense is an accrued expense. A prepaid expense is when you paid for the expense in advance of actually incurring the expense. This is opposite. We've incurred the expense, but we haven't paid for it yet. So the expense is recorded before we make the payment. And you'll see that with rent, interest, taxes, salaries, things like that. So to record the expense, we're going to have to debit the expense. That always increases the expense, and credit the liability because we owe for it. We haven't paid for it yet. So Sierra Corporation signed a 3-month note payable in the amount of $5,000 on October 1st. The note requires Sierra to pay interest at an annual rate of 12%. So what do we need to do? We know that when we pay back the note, we're going to have to pay interest on the note. However, interest accrues every period, every month, because the time has passed. We actually owe 1 month worth of interest. So how do you do that? You take the face value of the note, which is $5,000, times the annual interest rate, 12%, and then adjust for the time period, 1 month out of 12, and to get our interest for the month. If we were doing quarterly, this would be 3/12. And then we record interest expense and interest payable. Now a lot of people want to credit cash here, but we haven't paid for it yet. We've incurred the expense, but we haven't paid for it. Thus, we use interest payable. Another good example of accrued expenses is salaries. Sometimes an employee will work this period but not get paid until the next period. So we need to accrue the expense because we've incurred the salaries but not yet paid them. Here's an example. Sierra Corporation last paid salaries on October 26th. The next payment will not incur until November 9th. The employees received total salaries of $2,000 for a 5-day work week, or $400 per day. Thus, accrued salaries at October 31st are $1,200, which is 3 days at $400 right here. And here's a little picture of it. Okay, it said they last paid salaries on October 26th. However, they're not going to pay the next one until November 9th. But in October, that would mean there are 3 work days that employees have worked, but they've not been paid. And we're not going to record the payment because we're not paying them till next month. So the expense is incurred, but not yet paid. That's a perfect example of an accrued expense. So therefore, we need to debit salaries and wages and expense because they've been incurred, but not yet paid, so we don't credit cash, we credit salary and wages payable. So to summarize accrued expenses, we have things like interest, rent, and salaries that we accrue for. Why do we need the adjustment? Because the expenses have been incurred but not yet paid in cash or recorded. So what happens now is our expenses are understated and our liabilities are understated. So we need an adjusting entry, which comes, remember, all the adjusting entries come at the end of the accounting period to adjust our expense with the debit and our liabilities with the credit. Once you have completed all of those adjusting entries and posted them, we're going to prepare another trial balance called the adjusted trial balance. This is done after all adjusting entries are journalized and posted. The adjusted trial balance purpose is to prove the equality of the debits and credits. Make sure debits and credits still balance. The adjusted trial balance is the primary basis for the preparation of the financial statements. In other words, once we have that adjusted trial balance, which is the trial balance after adjustments, what we're going to then do is prepare our financial statements. So here is what the adjusted trial balance looks like. It's the exact same picture as the trial balance or the unadjusted trial balance we did in chapter 3. This is just after the adjustments have been made. Now we're ready to prepare the financial statements. Which of the following statements is incorrect concerning the adjusted trial balance? Well, it's the answer C. The adjusted trial balance lists the account balances segregated by assets and liabilities. What makes that incorrect? It's not segregated by assets and liabilities. It's segregated by debit and credit balances. So recall from chapters 1 through 3 that we're going to prepare our financial statements, but now we're going to do it from our adjusted trial balance. So we'll do our income statement, retained earnings statement, and balance sheet, same ones we've been doing so far in the class, but we're going to use our adjusted trial balance numbers to do that. So, for example, we're going to take all of our revenues and expenses and prepare our income statement. We're going to take our retained earnings and dividends and prepare our retained earnings statement. Don't forget that net income, we have to do the income statement first because we need net income to come down to our retained earnings statement. And then all of these in black up here are going to be used to prepare our balance sheet. And don't forget though that the retained earnings number here is going to go to the balance sheet. So you'll see the retained earnings number here, that came from our statement of retained earnings. And all of those assets, liabilities, and stockholders' equity accounts are going to go over to the balance sheet. Then finally, at the end of the period, what we need to do is called closing the books or make closing entries. What we do with that is at the end of the accounting period, they transfer the temporary account balances to the permanent stockholders' equity account, retained earnings. Now, what do we mean by temporary account balances? Those are balances that are open only for the current accounting period, which would be all of our revenue accounts, expense accounts, and dividends. The permanent accounts are all those balance sheet accounts, assets, liabilities, and stockholders' equity. So all of these temporary accounts have to be closed out. What does that mean? It just means we're going to make them zero, transfer them, so close them out, make them zero. We're going to transfer them over to stockholders' equity, the retained earnings account, and stockholders' equity. So all of the revenue accounts and the expense accounts are going to be closed into an account called income summary, which is then closed into an account into the retained earnings ledger account. And then your dividends are also closed into retained earnings. Now, how does that work? Well, revenue accounts we know have a credit balance. So to zero them out, we're going to debit them. And we debit them. The offset is income summary. With all our expense accounts, remember those have debit balances, so to zero them out, we credit them. And then the offset is income summary. But then that income summary, which now if you look at the two entries we made to them, we're going to take those and we're going to close it out to retained earnings. And then the final one is the the dividends closed out to retained earnings. So these 4 entries that you see here are done at the end of every accounting period after you have made all of your adjusting entries, after you've made all your financial statements. You're getting ready to start the new period, so you need to zero all those accounts out. Now, why do we do that? Well, for example, if I look at this revenue account, $10,600, that's revenue for October only. I don't want that to be in part of November revenues, so I'm going to zero it out to start November with nothing. So again, what are we doing? We're closing. This is what the T accounts look like from those entries we just made. We're going to, first of all, what do? We transferred the service revenue into income summary. Second of all, we transferred all of our expense accounts into the income summary here. And then those two, net of those two numbers, we closed out into retained earnings. And then the last step was the dividend account, and it was closed out into retained earnings also. So that gives us the ending balance and retained earnings. Remember, the retained earnings statement is beginning retained earnings plus net income minus dividends. So it's the same thing. And then finally, once you've completed all of your closing entries and posted them, we're going to prepare what's called a post-closing. Now, this post is not the same thing as posting the T accounts. This post means after. So after closing our trial balance. It's to prove the equality of the permanent accounts. That is, your debits and credits are all balanced out and you're ready to go into the next accounting period. All the temporary accounts will have 0 balances. So on this post-closing trial balance, you'll see no temporary accounts, no revenues, expenses, or dividends. So here's a summary of everything we've done in Chapter 3 and 4. This is very important, and it's called the accounting cycle. The accounting cycle, well, step 1, remember going back to Chapter 3, we analyze business transactions, determine how we're going to make the journal entries. Then we journalize the transactions, we post them to the ledger or T accounts, and we prepare a trial balance. Those first 4 steps we did in Chapter 3. Then what we did in Chapter 4 is from steps 5 on. We journalized and posted all of the adjusting entries. Then we prepared a post-closing, wrong direction. We prepared an adjusted trial balance, and from there we were able to prepare the financial statements, and then after that we journalized and posted the closing entries, and then finally we prepared a post-closing trial balance. Now all the temporary accounts are zeroed out and we're ready to start over again into the next period. So they call that the accounting cycle because we do this cycle every accounting period. We just go round and round, start the new month or new quarter. So I know that was another long chapter, but Chapter 4 is very important, and so make sure you spend a lot of time on this.